on the radio. You have a great day.
All right, great. Thank you very much, Daryl. Great job as usual. And again, like I said, and like Daryl said, if you go to this link, you put your information in there. It's just your name, your email, your phone number, and hit submit. It's going to send you an automated email with links to Daryl's free library that he talked about, some more videos that you guys might enjoy, link to our library, and then also access. He's doing a webinar tomorrow morning, and it'll also give you a 7-day trial to a Signal service. So again, you get a lot of really good information for free. All you have to do is just put your info in there. So do that, and you have to fill out all fields and put it in. And it's not like anybody's going to be hounding you, calling you at all hours of the day either. So it's just to put all the information in there. So Daryl, we appreciate it. We appreciate you going over those strategies, and we look forward to having you back very, very soon. At this time, I'd like to turn it over to our next guest, which is Robert Green from greencompany.com, and Robert's going to be talking about a couple tax issues for you guys. So Robert, real quick, if you can, before we get started, if you can do a quick audio test by clicking the mic icon in the bottom left.
Hi, can you hear me okay now, Morgan?
Yep, we can hear you. All right, and then two, in order to project your screen, if you click on the desktop sharing tab at the top, if you'll go ahead and do that. Okay, and if you will click the Start Desktop Sharing button.
Okay. So I'll install the software or launch it.
Correct. Mm-hmm.
Which one, install or launch?
Install. Yeah, you can install it.
All right, it's launching. And I figured everyone would take a break while we would just turn over the things here. I got an error message. But it's loading.
Okay, very cool.
I have a PR setup.exe. Am I supposed to launch that? Yeah, I'm Novia. Okay.
Yes. Yeah, give that a launch.
Installation complete.
Okay. How's everybody in the room doing today? You guys enjoy that first part of the session?
And I'll be getting started soon. I'm Robert Green, the CEO of Green Trader Tax. So if you want to know about protecting yourself from tax hikes in 2013, you want to take advantage of trader tax status, business treatment, very valuable tax elections. There's a lot of things to do now during January for both 2012, tips on preparation and setting up a team. So definitely stay tuned here while we get this set up to go with you. And Morgan, it still says waiting for the projector loads.
Okay. I tell you what, if you like,
I got it.
You can.
It did load.
Okay.
I see a PowerPoint now. Is that? Wait, it went away.
Now here we've got it loaded. What you can do is just use it on our end. All you have to do is click the arrow to the right to advance your slides, and you're ready to go. We'll turn it over to you.
Let me just try one.
Now,
is this the custom show or the full? Morgan, did you put up the custom show? Okay, yeah, it looks like.
Right, this is the show that you emailed me, so we've got it up and ready.
Yeah, that looks good. Just everyone's getting a taste of the screens. All right, it's a full show, but that's okay. I'll work off this.
Okay. All right. Sounds good. We'll turn it over to you, and the room is.
Thank you, Morgan. Thank you, Morgan. Well, it was nice to listen to Daryl. He did a great job, and Thanks everyone for coming. Some are our users and clients now. Others are maybe meeting me for the first time. So you should see the screen, post-fiscal cliff tax planning for traders and key trader tax issues to consider for 2012 tax compliance. That means preparing your 2012 tax returns. Some things you can still do. You can business treatment and deduct all your trading expenses, including startup costs. You can still do that for 012. But for 013, you're probably better off setting up an entity if you have trader tax status. That will look better and unlock additional breaks. And you really need to know what happened with that fiscal cliff deal. Does it affect you or not? So let's look at some of these screens here. This is educational information from Green Trader Tax. We are a CPA firm. We give you one-on-one advice, but not in a forum like this. TradingPub is not giving tax information either. Neither do brokers want to give tax information. So I'm the CEO and CPA from Green Trader Tax and Green NFH LLC, our CPA firm. We also head up Traders Advocacy to protect traders. You can read my McGraw-Hill, my articles in Active Trader magazine, Forbes blog, and you'll see me in all the media. Wall Street Journal, Times, Barron's. Barron's has recommended us every year since 1999. And you'll see me at the Traders Expo. I'm the main tax speaker. So the important first thing to grasp about the post-fiscal cliff deal is that only upper income taxpayers need to worry about Obama era starting in 2013. President Obama carried through on his promise to protect the middle class. He did let the payroll tax cut expire. That took a lot of expenditure. Now, that does not affect traders that much because trading gains are not subject to payroll taxes. If you pay yourself a fee with an entity to unlock some of our strategies, then you'll pay some payroll tax, but the fees are usually under $30,000. So unless you're making the big income, your taxes, you continued your Bush era tax cuts permanently. That's a very good thing. And on this third point here, you should keep taking advantage of all Green Trader Tax benefits, including trader tax status. That's the business treatment, all those business expenses versus investment expenses. People who invest in hedge funds, rich people, have investment expenses and they can't deduct them. There's all sorts of limitations. And they were pretty much washed out again with the fiscal cliff deal, with the peace limitation that came back. AMT wipes them out. You want business treatment. You don't want investment expense treatment. When you spend money on computers, software, chat rooms, services, all sorts of home office, you want a business deduction. It can save the average trader $8,000. So that's number one, trader tax status. You have to qualify. We'll discuss it. Section 475, mark-to-market accounting. That's when you get the ordinary business loss treatment, where all your losses can be unlimited and deductible against any kind of income of any kind. You don't get stuck with that puny capital loss limitation of $3,000. And you can have a net operating loss refund carrying it back 2 tax years or forward 20. Just 1 second here. Now also Section 988 Forex, the opt-out election, you can still do that to get into the lower 60-40 tax rates like futures, which keep the lower 60-40 rates. They didn't go to one rate so far. We still have a much lower long-term capital gains rate. And when you trade futures and other 1256 contracts, you get up to 12% lower rates. Make an extra $100,000, pay $12,000 less. Well, when you opt out of Forex, you can, in some cases, opt into those lower 1256G tax rates. Now, with an entity, you can unlock your adjusted gross income deductions for retirement plans and health insurance premiums. So this third bullet point, all the green trader tax strategies still work. They have survived the fiscal cliff. Now, there's additional tax reform coming up, and we're not out of the woods yet. Democrats are insisting on additional revenues as part of the debt ceiling, as the expenditures, appropriations, and the sequester. They've already limited the itemized deductions in this fiscal cliff deal. So what else are they going to do? We want to make sure they don't go to the one rate, take away the 60-40. So we still have to keep our eyes out. Now, what happened in the fiscal cliff deal? It's on this page. While most traders generally came out okay, upper income traders should consider a C corporation or a family limited partnership or an S corporation in 2013 to avoid Obama-era tax hikes. So again, it's only on the upper income. And there's a bunch of different thresholds, and it's very confusing. Remember, President Obama talked about 250,000 married, 200,000 single. And in the last minute, Mitch McConnell got 450 and 400, and everyone thought, wow, he did better. But he really didn't do better. Because, yes, the top rate of 39.6% kicks in at 450 and 400. But they have other tax hikes. They bring back the itemized deduction limitations of up to 80% of your itemized deductions. That can raise your rate from 33 to 38%. So in a sense, the tax hikes really kick in at 300 joint, 250 single. It's a little bit higher than the 250, 200, but not much. Qualifying dividends and long-term capital gains rate, that did stay at 15% for everyone except for the upper income, the same as the 450, 400 threshold, where it jumps up to 20%. So if you make 470 and you have 200,000 of dividends, a good chunk of it's going to be taxed at 15% or long-term capital gains. Now, tax reform shouldn't science. This is tax reform that's still coming. Trader tax status, business treatment, that gets to the heart of the golden goose when it comes to American taxation. The business, the small business, gets deductions, gets depreciation. I can't see President Obama in any way wanting to jeopardize middle-class small business. He's trying to protect them, and so are Republicans. So trader tax status, above the line business treatment, should stand up great. It's the investment expenses that are going to be limited. And so if you're status, you might lose most of your expenses. You lose already them now with AMT, the 2% adjusted gross income limitation. Now, this Section 475, mark-to-market accounting, the ordinary loss treatment, lose $100,000, write off $100,000, carry it back 2 years, get a check for $40,000, which included interest. That's an incredible replenishment of your trading account. I don't think that will be affected in tax reform. Congress expanded that code section from dealers to traders, and I haven't heard a peep about changing that. Section 988 going into, heard a peep about that changing. Now, Andrew Ross Sorkin of CNBC and the New York Times called me up and interviewed me about 60-40 about a year ago, the 60-40 tax breaks for futures. And he said that they were a loophole, and he put them on his list of loopholes, and he said some in Congress were talking about that. And he also, in the article, interviewed Warren Buffett, who threw 60-40 under the bus saying it was a loophole. I defended it. Bottom line, it's mark to market, so you can never get a long-term capital gain. So they had to do some negotiation to get part long-term, part short-term. Just can't be 40-60 or some other percentage, but there needs to be a blending. Let's go to the next screen. Now, here's the big takeaway from our post-fiscal cliff tax planning for traders, and there's a full blog on it. This is what you're seeing here on the PowerPoint are excerpts from the blog. So go read the full blog on greentradertax.com or greencompany.com. It was also in Forbes, Benzinger, and the Inactive Trader too. So the big takeaways are not upper income, and you never know in any given year. If you have a great year trading, you could be, you're not. But unless you're triggering those higher rates, you're good to go the way things were in the past. But if you're going to start getting into those upper income rates and having to worry about the tax hikes, the rate tax hikes, and that's not the only tax hike. There's also the Obamacare 3.8% Medicare tax on unearned income, which kicks in above 250. That's at it adds up to around 4%. That's why when you heard people talk about dividends going from 15%, qualifying dividends or long-term capital gains going from 15 to 20%, they said it was really more added in that Medicare tax surcharge on unearned income, which is investment income. So first off, if you're going to pay 39.6, and really it's 41% when you take out those eliminated deductions, that's a lot higher than the corporate tax rate. The first 50,000 is 15%, next 25 is at 25%, and then the rest is 34%. But the difference in the rates is even at the highest 34% for a corporation, it's 11%. So people are going to wonder, well, should we shift income to a corporation? And the answer is yes. If you're in a high bracket, why pay taxes at 45% when you can pay them at 15%? And then when you take a qualifying dividend years later, you're up to 30%. You put 15% in your pocket. Now you need to factor in state taxes. And if you're in a tax-free state, it's a great strategy. If you're in a high tax state, it may not be a great strategy. So the way you do that is you pay yourself a royalty. Traders create intellectual property, algorithms, trading systems, procedures, methods, and they can house intellectual property in a Delaware corporation or in your home state, and you can pay yourself a royalty. This is what the tech companies do. This is what corporate America does. Now you can also shift income to other family members. If you have children, adult age, and you're not worried about the kiddie tax rules, because you can't shift income with kiddie tax rules. They're taxed at your rate anyway. So if they're adult children or close family members, you have a family limited partnership, you can shift income to them with lower rates. If you're inclined to want to shift income to them, they're separate from you, but they're in the family. If you're supporting someone in a graduate program, let them pay their own tuition, get their own credits for education, which were extended. And, using trusts and gifts, you can do all that with the estate exemption, which remains at the 5.1 million and is indexed for inflation. So income shifting to avoid those income tax hikes, but only for the rich. Now, the other Obama era tax hike on the upper income, because remember, President Obama has cut taxes or continued the Bush era tax cuts and made other tax cuts for the middle class. So you want to consider using an S corporation. You don't have to do all these things. You can do some, all. Depends on your situation and where the money is. Believe me, we have a lot of clients that make a lot of money, and you're talking about huge tax savings here. If you're not in that upper income category, we're not going to bother with all this, these entity formations and all this compliance. Now, our attorney has a great idea. You can set up a partnership, pay royalty to it. It's a pass-through entity, and all of a sudden, later in the year, if you have a lot of income, you can check the box on the partnership to be a corporation. So it's sort of like alchemy. You can turn it right away into what you wanted it to be for the taxes. So this S Corp strategy, I'll just touch on it. I want you to read about it on the blog. You're making over $250, and I have a great example, by the way, in the blog of someone who makes $500. And this is cut and pasted from that example. By using this strategy, they saved $4,560 in Medicare tax savings. Instead of paying the 3.8% on $120,000, they only paid it on $30,000, and they saved it on the difference, the difference. So I mean, instead of it on 200, they reduced it by 80, and they paid it. Well, anyway, go to the example. I don't want to confuse the numbers here. So the bottom line is, when you have a trading entity, we want it to pay you a fee to unlock these AGI deductions. And usually that fee is around $30,000. Well, instead of getting $30,000, you're paying $120,000 to the S Corp. And then the S Corp is paying you the 30 it's reducing. So I think I have to fix some of the math here as I'm looking at it. It might be 90 instead of 80. So I'll review that. But the bottom line is that the S Corp becomes a middleman entity. I don't like to use the term middleman. It becomes kind of a conduit. So your trading partnership, instead of making 200, it pays a fee of 120. Yeah, that's what the numbers add up. It pays a fee of 120. And then your S Corp pays you the fee of 30. So the difference in the 120 and the 30 is where the savings is. You're saving the 3.8% on that difference. And you're still getting all your AGI deductions. So that's, in a nutshell, the planning for the Obama-era tax cuts. Let's talk about entities for traders. And if you have some questions, by the way, on the board about the first part of the presentation, get them up. I can see some questions on the board here. Let's take a look here. From George, you stated you can pay yourself a royalty if you have a Delaware C Corp. That would not apply to, yeah, it would apply to Nevada. Would a brother, sister be considered a close family member to set up a partnership with? Yeah, possibly. Do you have to be a trader to take advantage of these benefits? Yes. You need to be a business trader to take advantage of the benefits, because otherwise you're going to have investment expense treatment when you pay these fees. And so you really want to, we don't usually want to do it for investors. TJ, you can convert a 401k to a Roth 401k now. Yes, you can. And in the slides, right before year end, we talked a lot about Roth conversions for the upper income. We kind of felt their tax rates were going up. Why not check out beforehand? But if you were middle class rates, you didn't have to worry about your rates going up. So get some more questions on the board here. And let's see. Family limited partnership, yep, you can form it in your home state or an LLC. Batty had a question about broad-based index ETFs. Well, keep in mind that when it comes to ETFs, they're securities. When you get a publicly traded partnership K1 on a commodities ETF, it passes through some 1256 treatment. But when you sell that ETF, it's still a security. And if it's an option on a registered investment corp, a RIC ETF, that's a security. Only an options on a commodities ETF could be 1256. So check our content. We're not covering everything today. We have all this stuff answered. So entities for traders. This is a good time to set them up. We had a lot of people set them up right at the beginning of the year. They figured, hey, if I'm trading securities, why not just deal with the compliance in the entity and not have to also deal with that dreaded Form 8949 for cost basis reporting on their individual return? So it's a good idea if you're going to have trader tax status. It looks better. You want all the deductions, business deductions in a safer manner, because an individual files a Schedule C and there's no revenue on it, so it really looks like a losing business. The entity is consolidated with the revenue and it looks better. So an entity is the way to go for trader tax status, and then you pay yourself a fee to unlock those AGI deductions, and it just looks better on compliance and everything else. So let's look at this now. One simple pass-through entity is all you need. If you're in those upper income tax threshold rates, then you might want to add the C Corp and the middleman S Corp, but that's only for the very upper income. Otherwise, you start with the basic pass-through entity. Because you don't want to pay entity level taxes, you want to pass it through. But you don't want to pass it through in that top rate. The entity helps unlock adjusted gross income, AGI deductions, retirement plans, health insurance premiums, 100% deductible. When you have an individual 401k elected deferral, and then there's a 20% profit sharing plan on top of that for the individual 401k. So you can't do those AGI deductions if you're a retail trader with a Schedule C. So if you were a business trader, if you traded a lot in 2012 and you come to us, I may think you qualify for trader tax status, and I'll recommend that you add a Schedule C to your 2012 tax return to deduct all your business expenses. And if you have trading gains, we can transfer some of those over to Schedule C to unlock the home office deduction for even more benefits. And that's good for 2012. But for 2013, I'll probably recommend an entity because it opens the door better. Now, if you're a married taxpayers filing jointly, we usually recommend a general partnership since it's the least costly to set up and there are no state minimum taxes as there may be with LLCs. In California, there's an $800 minimum tax for the LLC. New York State and a few other states, there's a publishing requirement where you have to advertise in newspapers, Arizona, Pennsylvania. Now, I had dinner with our tax attorney Monday night, and Mark Feldman was saying he kind of thinks we should do more LLCs than general partnerships going forward. He feels there's more presumption of business purpose, and it would just look better to the IRS. And if someone doesn't mind the minimum tax, it may be a better way to go. Now, if you're single, then we recommend an S Corp, and you can form a single member LLC, an SMLLC, or a C Corp, a corporation, and make the S Corporation election. Entities don't file that dreaded Form 8949 for cost basis reporting that securities trader. What a headache that was for 2011, and it's going to be a headache again for 2012. Now, when you start a trading business, you go to, a lot of people get education. They go to DTI Trader. They get involved with TradingPub. They lay out some good investment for great education, and pre-business education is a very tricky area. We try to squeeze it into startup expenses, Section 195, where you can capitalize a reasonable amount, going back a reasonable period, like 6 months, write off the first $5,000 in the first year of business, and the rest over 15 years on a straight line method. That's Section 195. Because otherwise, if you don't have trader tax status yet and you're not using it on your tax return, maybe you have it and you're not claiming it, you're doing yourself a disservice because education is not deductible as an investment expense. Remember, investment expenses are very limited, but they're limited by 2% of adjusted gross income added back for AMT, limited by the peace limitation in 2013 from the fiscal cliff deal. But the point is that this is not even an investment expense, pre-business education. So you want to try to squeeze it into startup 195, but you got to start up a business to do that. So you want to stay clear of promoters' false promises for education deductions using poorly designed multi-entity schemes. They don't work, they'll cost you thousands and lead to huge tax penalties and interest if the IRS catches up with you. So you definitely want to consider the Section 195 startup costs, Section 248 organization costs, and both have that $5,000 first year expensing and then straight line depreciation. Now, if one of the most powerful deductions is the retirement plan deduction. By the way, if you're in that upper income, making $450, let's say you made $650, why not put away $200,000 in a defined benefit pension plan where you can put up to $200,000, getting your income back under the $450 and then not paying the top rate. That's another great way to get it down. Now, usually for most traders, we recommend the individual 401k plan. It combines the 100% deductible 401k, which can also be a Roth, but then there's no deduction. If it's not a Roth, you get the deduction, 100%. That's where the tax juice, the most of the tax savings is. And then if you have a great year, you max out and you do the 20% profit sharing plan going up to $50,000. And if you're over age 50, there's a catch-up provision for $5,500 more. Now, remember, trading gains are generally not earned income, so you don't owe the self-employment tax, and you also can't contribute to a retirement plan. Trading gains, net of trading expenses, are subject to the Obamacare Medicare tax of 3.8%. When you pay yourself a fee, that reduces the Obamacare Medicare tax, and it gives you earned income, and then you can do the AGI deduction. So if you get earned income of $30,000, you might get an AGI deduction for the whole $30,000, saving income taxes at 40% federal and state versus the self-employment tax of 15.3%. You put 25% in your pocket. You can save like between $2,000 and $17,000 a year. So keep track of the savings here. Trader tax status, save $8,000, $10,000, $15,000. AGI deductions, save $2,000, $3,000 to $17,000. Tax treatment elections, save tax rates 12% less when you get into 60/40. And then if you get hit with the Obama era tax hikes, you can avoid them. Now, we're not talking about hiding income and going offshore and not reporting it. We're not talking about any of those things. We're talking about trader tax status, business treatment, retirement deductions, shifting income, just more basic tax code legal things to do. Don't do anything illegal. You're just going to have a heap of trouble. And the IRS is all over everybody. Wash sales. What a pain in the neck. We dealt with this a lot at year end. You took a loss in December. You bought it back in January. Within 30 days before or after, a substantially identical position triggered a wash sale deferral. You think you made $50,000 in 2012, but with a wash sale deferral, you have to report and pay taxes on $70,000. Now, if you were above the capital loss limitation, a wash sale may not really affect your taxes that much. But What a pain. The brokers report them wrong, differently than you're supposed to report them. They report identical positions only. They don't do it across accounts. They don't do it with your IRA. You have to do it across all your accounts and with your IRA. If you elect Section 475 as a sole proprietor business trader, there are no wash sales on that. But this is where the entity comes in. If you trade in an entity, even without Section 475, it's a different taxpayer than you individually. It's different from your IRA. So you're not going to have the wash sale. So we told people, stop trading on 1231 as an individual, start trading on 1/1 as an entity. There's no wash sales. Even though you may have a lot of wash sales in substance, there's none in form because it's a different taxpayer. If you want to extricate yourself from wash sales, you want to talk to me about Section 475, about an entity, because wash sales are a pain, and you should use our trade log software to account for those. Just give me a second to drink something here. Now, trader tax status. These were issues at year end. Let's skip over that. That was from a slide before year end. So the Obamacare 3.8% tax, you probably read about it in all the media. It's all over the place. Kicks in at 250 and 200. It's on all your unearned income. And you know, that's your trading. That's your interest, dividends, most capital gains, royalties. Now, the Form 8949, that's that IRS cost basis reporting, that's still going to be a royal pain this year. You need trade log to generate the Form 8949. Your accountant will botch it. If they say, oh, I'll use the 1099, garbage in, garbage out, it's completely wrong. So you're not kidding. You shouldn't try to kid yourself. Your taxes are wrong, and you're going to have problems. So read about that on our website. We have led the country on cost basis. We've been interviewed in Wall Street Journal, Barron's, everywhere about it. Keep your eye out for the financial transactions tax. It's snowballing in Europe. If it is ever launched here in the U.S., it could put traders out of business overnight. It does apply on French ADRs now, but some of the brokers are absorbing that. I think TD Ameritrade is. So try to back politicians who are against it rather than back the ones who are for it. Really, it's coming from the progressives. We don't want someone to give any credence to the call for balancing the budget with a financial transactions tax, and it has come up as an idea. So read about that on our website. We have a separate website for that, Traders Advocacy. We've been fighting really hard against it for years now. A lot of traders don't take it seriously. I said it was going to snowball in Europe, and it has. And it's on the verge of passage among 11 countries. And it's going to cause a huge mess because they're going to try to explode it into London, New York, and Chicago. You can avoid French ADRs now, but with 11 countries, there's going to be a lot of stuff to avoid. So let's take a look at a few more questions here. And I'm not sure on the timing how long Morgan wants to go, but let's see how we're doing with questions. You can start Jeff, you can start a single member LLC, and you don't have to file the S Corp election right away. You can see if you want to admit someone else, like your spouse, as a member, or you don't want an investor in there, because then you have to worry about investment management issues. And the IRS lets you file a late S Corp election, but you got to make sure your state does too. One second here. I'm just trying to view questions here. Let me, French ADRs are on the French America, so they're subject to the French financial transactions tax, which is pretty hefty, but some of the brokers are trying to absorb it. if you have a EL, if we form an S corp, then yes, you'll need payroll compliance. You can use an admin fee the first year, but later on you should really have the payroll. So keep your questions coming up on the board. I think again, the ETF. Jeffrey's asking about trader tax status. So I think we went through some of these tax attributes of it. We said it's for any type of trader: securities, futures, options, ETFs, forex. You can learn about it and claim it for 012. You can't tax treatment elections like Section 475 and Section 988 opt-outs. Those will have to be done contemporaneously, but claiming business treatment you can do after the fact. They're related, but two separate things. Check the golden rules on our website. Go to greentradertax.com. I'll put into the chat screen here the site. You go there. Maybe I'll put it with the link. And right up top, there's a Trader Tax. You can click on the Trader Tax Center, and right on the first chapter is Trader Tax Status, and we have the golden rules right there. So see that free Trader Tax Center. So you can claim it for 012 on a Schedule C. Now, these are more slides. This was a full presentation, which I'm not giving today. Futures accounting is easy. It's summary reporting. So is Forex, but you don't get a 1099. Securities are the pain in the neck. That's when you need the trade log. You can't use a worksheet. You can't use an accountant. There's only one solution, the trade log. If you don't agree with that, read our site. So tax treatment's a big thing. Securities have the ordinary tax rate. 60/40 is a lot less. You always want to try to get the lower 60/40. You don't want to deal with war sales. Now 60/40, remember, it's mark to market. I'm just rushing through some of these other slides because we weren't really set to cover these. Morgan loaded the full presentation. I had a custom presentation, which was shorter to fit the time allotted. But I'm giving you a taste of this, and this stuff is on our site. Traders don't need an entity. They can be a sole proprietor, but the entity looks better, and it gives them the AGI deductions, which is better. Business expenses are unlimited. Investment expenses are very limited. We covered this. Stock options, and securities. You want to see what's in 1256. And then you want to learn all about the ETFs. It's on our website, how they're taxed, the securities ETFs, the commodities ETF, the precious metals ETFs, the ETF options, the foreign futures, the Forex. All this stuff is taxed differently. There are elections. If you don't know about it, and there was an election you could file and you didn't file it, you're going to really kick yourself when you realize how much money you lost later on. And there are deadlines for these elections. 475, you got to do it by April 15th, or March 15th if you're an S corp. The 988 is contemporaneous. You can do it today. So the trader tax status, full-time or part-time, we want to see you executing 75% of available trading days, like 3-4 days a week that you have a trade, frequent, continuous, regular, continuous business activity, working every day, 4 hours a day, 500 round-trip trades a year. Taxable accounts count. Retirement plans don't. Day trades or swing trades. You're not holding stuff for months. Intention to run a business. Serious tools and account size. Check with me. Read the rules on our site. Get the Green's 2012 Trader Tax Guide. The 013 guides will come out soon. You get those for free as an upgrade, free upgrade. I'm actually working on those now. I wanted to wait for the tax law changes. And then maybe have a consultation with me to see if you qualify. So the pitfalls, you do not want to get stuck with losses you can't deduct. Work with us, see how to deduct your losses. Now, if you're an investor trading securities, there's nothing you can do. But if you're a business trader and you have 475, you got business ordinary losses and big refunds coming. A lot of tax return reporting tips. In our guides, our examples guides, a lot of accounting tips. A lot more in-depth information on entities, tons more on retirement plans, on the self-employment tax. So let's look at some, those are the slides, and let's take a look now at some more of the questions. You have a capital loss carryover, Paul's asking. Can you somehow get 475 and turn it into an ordinary loss? No, that's the problem, Paul. When you have a capital loss carryover, you're in the ditch. You need a capital gains ladder to use up your capital loss carryover. So if you form a new entity, you want to pass through capital gains to your individual return to soak up those capital loss carryovers. If you jump the gun and elect Section 475, you're going to have ordinary income, which cannot be offset by capital loss carryover. So when you're in the ditch with a capital loss carryover or a large unrealized capital loss, you want to consult with me about how to make the right moves using hindsight and flexibility where allowed to navigate that decision in the best way possible so that when you have a gain, it's a capital gain, but if you have a big new loss, it's a mark-to-market loss. And we do that with entities. Much more complicated than the scope of this session today. Read about that on our site. Are really good guides. I mean, I would get that Green's 2012 Trader Tax Guide. Chapter 1, Trader Tax Status. Chapter 2, Section 475. There's chapters on entities, on retirement plans. Look at the Trader Tax Center on our website, the free one. Each one of those chapters is an excerpt from the guide, so that will give you a good taste of what's to come. So let's see if there were some more questions now. I think we're pretty much done with questions, Morgan, and I know you wanted me to speak for about 45 or 50 minutes. If anyone else has a question, why don't you get it up on the board now? But otherwise, give us a call. Mindy is really helpful, and tax compliance is our biggest business right now. So we can do a lot on your 2012 tax return. And what we can't do, we can then try to make up for with 2013 planning. If you're in a ditch, if you made some mistakes, you did some pitfalls, we have to climb out of those in 2013. So just to wrap up, if you trade a lot, you probably need to talk to us. Even if you don't trade a lot, you need to know about tax treatment, Form 8949, all those issues we talked about in tax treatment. You still need to know because a lot of them are not conditional on trader tax status. If you lose money, you're a good client for us because we can show you how to deduct it and get refunds. We don't just work with the VIPs making a lot of money, but we work with a lot of them too. It covers the gamut. So thank you very much, Morgan. It was nice to be in the Trading Pub and to hang out with everyone here. It was fun, and thanks people for having your questions. Someone asked where we're located. We're located at a click away from you. We're a virtual firm. I'm in Connecticut today. I'm also in New York City on the weekends. And we have CPAs around the country, tax attorneys too. So we know all the states, you know, California, Texas, those are our two biggest markets actually. We know all the states really well. And go to our website for compliance. Click on the virtual process and you will see why it makes a lot of sense to work that way. You're here virtually today. So with Skype and video and online meetings, we can do a much better job than the one-on-one, the old hand over the paper, because we're paperless. So thank you all. And thank you for your nice comments on the board as well. I appreciate that. And Morgan, back to you.
All right, great. Thank you very much. We appreciate you being here. We definitely look forward to featuring more from Green Trader Tax. Again, guys, you can check out if you go to www. And I'll type the link in here. It's www.greentradertax.com and learn more. I know they've got a lot of great resources on the site. And like you said, if you have questions, feel free to give them a call and they'll be happy to help you. So again, Robert, thank you for taking the time to be here. We did record the event. For those of you that are just joining us, Daryl did an outstanding job earlier, and we had Mr. Green do an outstanding job as well. So I think you guys definitely got your money's worth today, or at least I would hope that you did and that you enjoyed the session. So be sure to learn more at greentradertax.com, and we posted this link earlier if you want to gain access. If you kind of liked what Daryl talked about, and I'll type this in. If you liked what Daryl talked about, you can gain access to our trading library by clicking that link and also get a 7-day a coupon code for 7 days of Daryl's signal service. So Jeffrey, I'm glad that you enjoyed it. Again, we try to keep these presentations long on education and short on fluff. So we'll get a copy of the recording posted hopefully tomorrow morning. We'll email it out to everyone. As always, be sure to follow us on Twitter and Facebook if you want to get updates on what we have going on at the Trading Pub. We've got a big event this Saturday, and when we end the room, it'll take you to a page where you're welcome to register for that. Thanks, everyone.